Um, so the basic issues is that we've got these multi-factor affine models that seem to be working pretty well, both for pricing options and for time series analysis. So here are a couple of papers that I particularly highlighted in a recent survey for the Annual Review of Financial Economics, which just came out yesterday, if people want to look at that. But these are two multi-factor models I especially like. The Anderson-Vazarian-Todorov model that fits option prices really well. And then there's the Gruber et al. Paper that uses Wizard processes plus jumps. So those are, they fit option prices well. And then I've been working most recently on time series analysis using these affine models. And at this point, I've got it fitting stock market returns pretty well as well. So my 2009 paper in Journal of Finance used intradaily data and found that these co-jump models, so price volatility co-jump models with self-exciting jumps, actually fit stock market crashes really well, which had been a problem in my earlier papers, that typically when you estimate these models, the crashes are outliers that the models have difficulty matching. These models match them, or at least so the crash of 87, crash of 2008, the models match pretty well. A basic question, however, and certainly the reason I got into option pricing, was whether the option pricing models we work with are actually consistent with the time series properties of the underlying. So that's where I got started, Princeton, back in summer of 1987, was I was trying to use, I felt that fears of currency crashes might explain the carry trade. And I wanted something that would indicate fears of currency crashes. So I turned to currency options, figuring that if there are fears of crashes, it should show up in prices of options. And that's what pushed me towards these models with crashes, such as the Merton 76. So we have we've been fitting the cross section of option prices with these models, but and identifying phenomena, but we really want to know if what the options are saying is actually borne out in the time series. So is this information from options reliable? Of course, we have to adjust for compensation for risk, but is there some direct evidence in time series that these models are capturing something? So for example, here's the average volatility smirk. So it's the difference between implied volatilities of calls and puts that are exactly one standard deviation out of the money, as measured by the at-the-money implied volatility scale by square root of the time horizon. And what I've been thinking about most recently is longer-term leverage. That we've got our high frequency phenomena, but I'm wondering about lower frequency phenomena. So according to the options, first of all, according to the Backus et al. Decomposition, this skewness measure, this difference between implied volatilities is directly proportional to risk-neutral skewness. So this is a proxy for risk-neutral skewness, and what it's saying is that there's pronounced risk-neutral skewness at longer horizons. And to my mind, that's a better model for downside risk than, say, the time-varying rare events, disaster risk models. So but that's what options are saying. What I wonder is there evidence in time series that this sort of phenomena is present? Certainly, we've seen periods like that, most notably the Great Depression, where certainly, well, we started off, of course, with the crash of 1929, with down 12%, up 12% in 29. But more relevantly for the Great Depression was then what the S&P 90 then fell 80%. So over the space of years, basically. So that longer term sort of phenomena, which the market is following and volatility is going up, is what I'm interested in, and which I consider a better model of disaster risk than time-varying stochastic intensity rare events. So I want to know whether there's longer-term leverage in time series. So now My previous papers, however, focused on relatively high frequency data. My 2012 paper used daily stock market returns going back to 1926. This paper, 2019, used intradaily data, S&P 500 futures. And of course, those only started trading more recently, 1982. So if you use high frequency data, you find high frequency phenomena. But I'm interested in lower frequency phenomena. So that's the basic objective. To focus on longer term volatility dynamics and particularly longer term leverage, the objective of this paper is to use two data sources that are sensitive to longer term volatility. First is just a longer history of stock market excess returns, the same series that I used in my 2012 paper. But what I'm doing here is bringing in a new data source, the VIX. So the basic logic, basic idea is that the VIX is based on 1 month option prices. So it should be more sensitive to state variables that affect longer term volatility, basically, as opposed to daily stock market returns. So that's what I'm doing, bringing in the VIX, but just bringing in the VIX as an information source. Now we know the VIX is informative, but we also know it's biased. So here's just a basic forecasting regression over the period from the full sample 1990 through 2021. If you regress realized variance constructed in the VIX style, so log returns minus percentage returns, using this, which is approximately sample variance. But anyway, throughout, I'll be using this measure of realized variance to be consistent with how the VIX is constructed. If you use these forecasting regressions, here's just regressing the VIX squared, so using this proxy here. And it's got a lot of information. The slope term is close to 1, but the VIX is upwardly biased. So we don't have 0, 1, and indeed we strongly reject that hypothesis. However, the VIX is roughly informationally efficient in terms of if you add, say, lagged forecast errors from a month earlier, then it doesn't contain much information. You get about the same R squared, and it's not statistically significant. So the idea is to use the VIX because we know that it has information, at least for future volatility over a 1 month horizon, but adjust for its biases. So the underlying model that I use is this basic two-factor additive model in which, so it's a jump diffusion model with cojumps. So this is the underlying log asset price for the stock market. So we have diffusive components and we have jump components. And importantly, we have cojump components. So the diffusive components, the diffusive shocks are correlated and the estimates have them negatively correlated. So that's one form of leverage. And but the jumps are also correlated. So I'm using the Duffy Pan-Singleton specification in which the jumps are an exponential jump for the spot variance terms, and then plus a Gaussian shock. So the total asset shock is an independent Gaussian shock plus some leverage term on the volatility jump. And importantly, this is a self-exciting structure. So when we have jumps in either the variance state variables, they increase the probability of more jumps occurring, and those jumps tend to be negatively correlated between price and volatility. So we have leverage in two facets, two approaches. One, and then there are two factors, basically a faster moving component and a slower moving component. And then the rates of mean reversion will govern how fast they mean revert. And then I've got this hierarchical structure for jump intensities in which the slower moving V process can affect the jump intensity of the faster moving process, but not the other way around. Okay, so that's a basic additive model. And then being an additive model, we have an exponentially affine moment generating function. So the expectation of the exponential transform conditional on V takes this particular form. And then we can condition on what we know at V at every point in time using a filtration procedure I'll talk about in a moment. The downside of self-exciting jumps is that we no longer have closed form solutions for C and D. So I would say that's probably why they have been less studied. Certainly, I was thinking about this model back in 1995, actually, but precisely because I didn't have a closed form solution, I didn't explore it. But I'm going to argue that it does well. So, but solving for C and D therefore has to be done. There's an element which has to be done numerically, but it turns out that's not too bad. So what I do is I just, in essence, solve a system of ordinary differential equations for C and D, and along with their first and second derivatives with regard to this C parameter. That can be just solved using the concatenated approach that I used in my 2012 paper, Appendix A. And then I take days and then chop days into 16 subintervals. There's a lot of information that stays constant within the concatenation. So it actually, the evaluation of C and D goes pretty fast. And the fact everything's evaluated jointly also makes these operate pretty fast as well. Now, I said I've got two data sources. One is stock market returns going back to 1926, and the other is the VIX. As I discussed in my 2012 paper, however, there are problems using historical data. In particular, the stock market returns, actually these are excess returns, so log returns relative to the risk-free rate. Excess returns were autocorrelated in the 40s through the 70s. So this is something that Lowe and McKinley pointed out, also Fama and French in terms of their variance ratio tests. So the stock market was not a random walk over this period. A probable reason is that just stale prices. This was a period in 1940s through 1970s when stock market turnover was quite low. And whereas if you go back to the 20s and 30s, it was much less pronounced and stock market turnover was larger. I discussed this in my 2012 paper and using turnover measures from Ken French's presidential address. And basically turnover was high in this period, low on this period, and high again starting in the 80s and 90s. So, and as you can see, correspondingly, the autocorrelation of the stock market has fallen to within plus or minus 10%. But back in the 60s and 70s, the autocorrelation was running at 30 to 40%. So, so what I did, as I did in my 2012 paper, was I just say observed returns are and the autocorrelation times the previous day's return, plus a scale factor times this shock of this underlying change in log S, where log S is the permanent impact to stock market changes. So back in the 60s and 70s, it was being obscured because, say, if half the stocks don't trade, you only see the stock market responding to half the stocks trading, and the other half don't trade till the next day. So you can get lagged responses of individual stock price responses, and thereby affecting the stock market as well. Of course, it's mostly a problem over this period. Although it's still, there's some interesting gyrations back in the 80s and 90s that we can think about. Also, this autocorrelation estimate, this is just a time-varying coefficients model. I just treat the autocorrelation itself as a state variable, and that state variable is one of the latent state variables that I'll be estimating as part of the time series procedure. By the way, the permanent impact, however, is what we care about mostly for the VIX, because these autocorrelations are effects mostly at a daily horizon. Once you aggregate up to a 1 month horizon, the it's the delta S that's important, not so much the Y. Okay, now here's the model. So basically, I'm just modeling the VIX variance bias as the difference between the risk neutral quadratic variation, expected quadratic variation, and the objective quadratic variation. You can call it a variance risk premium if you want, and certainly that would be the definition of the variance risk premium. I'm agnostic on that topic. Maybe it's a variance risk premium, compensation for variance risk. Maybe it's problems with using options data. So the VIX portfolio replicates the log contract of Neuberger, and but there are issues of strike price range, for instance, as Torben Andersen and co-authors have discussed. Also, when replicating the VIX, there are a lot of puts on the downside, but the calls on the upside are thinly traded. So it's possible that there are construction issues just using the VIX. I'm not going to particularly try to interpret the VIX, the bias results, but basically what we're doing is that I'm saying that the VIX, or rather squared VIX, is the expected quadratic variation on this VIX basis, conditional on whatever information we have, plus a bias term. And then the expected quadratic variation in these affine models, well, it's just going to be a linear function of these state variables, V1 and V2. That's the whole point to using the VIX, is that it places a heavier weight on longer term, slower moving variance state variables. But then there's this bias term. So I just modeled the bias term, and the modeling of the bias term, the distribution of the bias term, generates the distribution of the Z. So the particular, I used just a very simple daily model for the bias, basically that it's autocorrelated. So it's an autoregressive bias, so some constant, some autocorrelation in the previous day's bias, which of course would be the difference between yesterday's VIX and yesterday's assessment of quadratic variation. And then plus possible some sensitivity to the shock to the stock market relative to what was expected, and then some sort of noise term, mean zero. And then I use a couple of approaches. One is just to start off with the noise term as Gaussian, but heteroscedastic depending upon the levels of variance of V1 and V2. But I then also move on to a model with Gaussian plus jumps in B, where the jumps are also sensitive to the observed return. So basically, we're just exploiting the information in observed returns, either directly for so just seeing whether observed returns are affecting the estimate of the bias, or in the case of outliers, whether the magnitude of the return conditional on a jump is affecting the bias. Now, that said, it's not, I'm still working on this model. It's not quite a co-jump model. So I think a co-jump model would be better for jumps between B and then the jumps in the V variables that affect Z in the return. So it's a partial model, basically, and it could be made better. The point, however, the whole objective of this exercise is to use these two data sources. So we're observing daily stock market returns. We're observing the VIX and how it changes over time. So these two variables together will give us information as to how these state variables V1 and V2 are changing, and also the overall structure of how it is that V1 and V2 change. Secondly, with this estimation procedure, we can decompose changes in the VIX into its various components. So VIX changes, or squared VIX changes, either because V1 or V2 change, or because changes in the bias. And by using both VIX data and stock market return data, we're requiring that our estimates of V1 and V2 be validated in terms of some ability to capture the distribution of stock market returns. So it's not just estimating what is the VIX process, it's this interaction, the fact that both of these variables, Y and Z, both depend on V1 and V2, are helping me to identify the V1 and V2, how they change, but also the biases, any biases that VIX might be making. And there are legitimate reasons for such bias, such as variance risk premium, or it could just be problems such as constraints in the options market during 2008. Okay, so that's the basic objective. Let me pause for a moment, see if there are any questions as to what I'm trying to do before I go on with how I do it.
There are no questions in the chat yet, but I think if anyone has a question, please feel free to unmute yourself and shout it out. Okay, everyone's shy.
Okay, then I will continue. Okay, so this is maximum likelihood. So I'm going to be estimating using my two data series. So the log likelihood will be the sum of the log densities of observed excess returns conditional on just the stock market data over 1926 to 1989, when I don't have VIX data, of course. But over 1990 to 2010, I'll be looking at the joint distribution of stock market excess returns and VIX conditional on past information, where past information either includes the past history of stock market returns and or the past history of the VIX, basically. Obviously, I can't use the past history of the VIX until I get up past 1990. And I see Stylianos has a question. Let me just see if I can.
Can you hear me?
Yes, go ahead, Stylianos.
Okay, the big question, of course, is the elephant in the room. You know what the elephant in the room was. There is no place there for the transactions cost. There are big, the VIX is extracted from short-term options, which are about 30 days, if I'm not mistaken. And these have been known where they are massively mispricing. They are repeated, if you like, papers. The last one came in 2021 by Post and Longarella that show that it's mispriced in the sense that there are, if you like, excess returns, riskless, risk-adjusted excess returns by trading all these options, and they found it, algorithms. And also there is the one, Konstantinidis, Chervonko, and Perakis a year earlier. So this, there may not be enough to eliminate through trading for a variety of reasons, but they certainly would affect the estimation, if you like, and the adjustment of the bias. They would. That's my question. Would this play a role in the bias?
Absolutely. So all that, I'm not saying whether VIX are reasonably priced or unreasonably priced. I'm just saying that this deviation between what the VIX says the forecast should be and my time series estimate of what it should be, that difference is showing up in the bias for whatever reason. So it could be bid-ask spreads, could be construction issues, could be compensation for variance risk. I'm not concerned about that. All I'm concerned about is using the VIX as an information source for improving my assessment of the time series properties of stock market returns.
Just one more comment, the little comment. If the Post and Longarella, they proved, and also we had proved it earlier with Konstantinidis and Jackworth in 2009, that you have to have a monotone kernel passing through the bid-ask spread, otherwise there is mispricing. At least this can be, if you like, verified and see if it responds to the VIX. That is a verification, that just a suggestion that it can be useful in terms of, if you like, accounting for economic forces for the buyers, not just fitting.
I'm not trying to explain the bias. I'm just estimating the bias and making an adjustment for the bias when using the underlying state variables.
All right.
Okay, so here's the maximum likelihood procedure, and then I've got a filter basically. I'm going to be estimating my latent state variables and using two data sources. So I have stock market excess returns. I've also got observed VIX, which has this noise element captured by the bias, and it's not a mean zero noise element, and nor am I trying to model or explain the magnitude of the bias. So I'm not building in an explicit pricing model at all in this framework. So I'm just using it as an information source. And then I'm using the filtration approach that I laid out based on a moment generating function, conditional moment generating functions in my 2006 RFS paper. Now, the work I've been doing since 2006, my 2012 and 2019 papers have been using a univariate filtration approach. So one data source, but multiple latent state variables that we're trying to estimate. That's relatively tractable. So one of the objectives of this exercise is using multiple data sources. Problem is we have a curse of dimensionality when we come to multiple data sources. So here's how the filtration procedure. So what I'm doing here is updating joint moment generating functions of in particular of the sorry, I should have eliminated these the phi and psi terms here in this. So there's an error there. Well, we're only interested in the moment generating function of x, and then this is the updating procedure. So this is Bayes' rule for characteristic functions, in which you start with the joint moment generating function of the observed data and the latent variables. And then the moment generating function just of the latent variables. This is the filtration procedure. We just integrate this joint function over these terms and divide it by the conditional density, where the conditional density also involves this double integral. And then that gives us the conditional moment generating function of the latent state variables x. And then if we take derivatives of that, we can get the conditional mean invariance of the latent state variables x. So that's the filtration procedure. Problem is this curse of dimensionality. We're doing, in this case, there are two observed data sources. So if it takes n integrand evaluations per data source, we're going n squared. So this just, it's okay for univariate integrations. Bivariate integrations get much slower. So that's, as I pointed out in my 2006 paper, this is one of the major limitations of this filtration procedure. The solution I've come up with for this paper is sequential filtration. So what we do basically here, we're trying to evaluate this joint, we're trying to, basically by Bayes' rule, the joint density function of observed variables y and z and latent variables x, just do it as the density of y and the joint density of z and x. So it's just sequential. Basically update based on y and then update based on z. If I vaguely recall that this is something they actually used to do in the early days with basic regressions, that they couldn't run multivariate regressions given lack of computing power. So basically they would convert multivariate regressions into a series of univariate regressions by projection. This is basically what I'm doing here, is this sequential projection, first projecting on using y data and then projecting using z data. So we use the observed y to update the joint conditional characteristic function of z and x. And then we use observe Z to update the conditional characteristic function of V of just those components. Here are the latent variables we're interested in. The previous day's V, the new day's V, and this autocorrelation parameter rho. So when we do Z, we're only interested in next period's state variables. So we don't have to fully update X, although we could do so if we wanted to. Now, all of this does involve a lot of univariate integrations. So in this first step, where I'm updating based on Y, I have to compute this conditional density, which involves an integration. And I have to evaluate the conditional characteristic function corresponding to this. So I'll need the means and variances of X, and then I'll also need covariance terms between yesterday's V and today's V. And that's for step one. And then for step two, I'll have 7 integrations for density, means, and variances. Now, that's a lot of integrations, but they can all be done jointly. There's so basically what I programmed up a vectorized version of basic Gauss-Cronrod rules for quadrature from the IMSL Gauss-Cronrod rules, just make it as a vector structure rather than a univariate structure. And all of these integrations are used a lot of the same information. So if you do them jointly, it's quite efficient. And I find it's actually as efficient as my old univariate stuff. So I can do this filtration within a few minutes for given parameter values for 1926 to 2010. It's a fast procedure provided you vectorize. Now, I do need the joint density of V yesterday and today. So the V's yesterdays and todays, of course, are highly correlated because, today and tomorrow. So tomorrow's V will be today's V plus a shock. So those are going to be correlated. Furthermore, the shock is negatively correlated with stock market returns. So when I observe Z, I'm updating both of these terms, as well as, of course, the change in them. So there's quite a bit of that's why we have to update the joint the joint distribution of V of the V's. That said, these are 2 state variables that are largely assumed independent, not quite, but largely. And certainly on an intradaily basis, they're assumed independent. So the V1 and V2 are treated separately, or are treated as independent. Okay, and then when I'm updating this bias, basically I'm looking the bias today. The bias affecting the latest Z is certainly measured based on yesterday's VIX relative to what was forecast. Also, the sensitivity of returns, this beta BS is estimated, and so forth. So this is the sequential filtration procedure that I'm using for estimating. Okay, and then here are 3 models that I will emphasize in this talk. So the first model is just estimating purely off stock market excess returns. So using those for over 1926 to 2010. The second model is using these data over this period, but the joint distribution of returns and the VIX, but only using the stock market returns for filtration, basically to see what difference it makes when I go from this model to this model. And then the third model is where I fully use the VIX information for updating the distribution of stock market excess returns, as well as the distribution of Z returns. So we have flexibility as to what information we choose to use when filtering. Okay, so here's the benchmark model for stock market excess returns. This is the fit. When I include Z variables, the ability to fit stock market returns drops a bit. Here's the fit for the VIX based on this information and based upon the latest daily excess return. And then when I include the Z information here, I do a little bit better for stock market excess returns, not a lot better, which surprised me. I was expecting the VIX to be more informative than it seems to be in terms of stock market excess returns. But of course, I'm basically incorporating the VIX information via this procedure. But what really makes a difference is from Model 2 to Model 3 is the ability to capture the Z distribution. So that's what really jumps here in an improvement of the log likelihood. So as I said, the model is doing pretty well for stock market returns. So what's important about these graphs is what is not there. So these are normal probability plots, and if all these numbers, basically it's a histogram. So the red line is the theoretical histogram if the model is correct, and the black line is what's actually observed. And what we're not seeing are major outliers. So what these graphs indicate for models 1 and 3 is that we are indeed capturing the stock market crashes in 1929, 1987, 2008. We don't have major outliers that would show up as a 6 or 7 standard deviation movement according to these numbers. So it's doing a good job of fitting the time series, and it's not making much difference in terms of fit. So basically, these different models don't change this much. They do seem to be affecting variance forecasts. So here's, again, just these variance forecasts. So here are univariate regressions. So here's the VIX regress. Here's realized variance regressed on VIX, for instance, but over this 1990 to 2010 period. Again, highly informative, but biased, and p-value less than 10 to the minus 8. These others, notice these, the intercepts require bias adjustment typically, except for the third model. The third model, no bias adjustment seems necessary. Okay, so those are the univariate models, and then here are encompassing regression results. And generally, the VIX is not statistically significant in any of these models. So they're doing a good job of capturing a realized variance. Now, there's an element of realized variance. When you're using squared daily returns or the VIX equivalent, that's a point where this autocorrelation state variable does matter. So we have to, in terms of these forecasts, we have to scale up the realized variance by this 1 minus the autocorrelation term, which is affecting the conditional variance of the y's. So, and here's an R squared. Here's just a horse race. So on an unadjusted basis, this model 3 that incorporates the VIX information into its forecasts of y is doing the best, but pretty comparable to model 2. Of course, on a bias adjusted basis, the model 2 is doing best, at least in sample over this period, 1990 to 2010. But when you backfill and see how it fits data back to 1926 to 1989, Model 2 does worse. So Model 3 is a good model, basically. Model 3 on an unadjusted basis does well, and the adjusted is basically the same as the unadjusted. So it's also doing well when backfitting the data for 1926 to 1989. And then out of sample, everything's doing about the same. VIX and all the others over the post sample, and that's true here as well. Post sample on an unadjusted basis, Model 3 is again the best. Cojump parameters. These are cojumps. They're small but self-exciting. What comes out of this table is that V2 is basically a diffusion. So I was looking for jumps in the slower moving variable that certainly affects the VIX. So if there are jumps in VIX that are justified in terms of providing information for forecasting future variance, I theoretically should pick that up. In practice, however, all the action seems to be V1. So that all the co-jump activity is in V1. V2 is effectively a diffusion. I could just suppress the jump component of V2 and it'd have virtually identical log likelihood. Here's a key result. Now I do have leverage. So while V2 is effectively diffusive, and I could just suppress the co-jump components, there is still substantial leverage. So there's a major correlation between shocks to the slower moving variance state variable and shocks to DS. So a negative 44% in model 1, negative 55% in model 3. But the major activity is in V1. So V1 is the faster moving component. And of course, the other component is just how fast moving they are. So if I use time series, model 1 is using purely stock market excess returns. And this is the half-life in months. V1 has a half-life of less than 2 weeks. V2, according to time series analysis, had a half-life of 15 months. And that's comparable to what I estimated in my 2012 paper using a central tendency model, where the central tendency had a half-life of a year. However, once I bring in VIX data and the dynamics of V1 and V2 based on adding VIX data, it's much faster moving, the slower component. So now V1 is a bit more than 2-week half-life, so 0.6 months. But notice the slower moving component is nevertheless faster moving. So there's a half-life of 4.5 months as opposed to the time series estimates of 15 months. And that's going to matter later on. Okay, so this was not what I was expecting and not what I was hoping to find. I was hoping that using the VIX, I would be picking up even slower moving components. And that's not what I'm getting. Here's the normal probability plots for the Z, depending on what specification I'm using for the bias, how I model the bias term. And Gaussian shocks do badly. So I've got some major outliers, including this outlier here, which is October 20th of 2008, when the stock market jumped 4.7% and VIX dropped. With a Gaussian specification, that's a major outlier. With a non-Gaussian specification, that's no longer an outlier, so it does pretty well. So this non-Gaussian specification is working pretty well, but you can see there are major outliers on the upside. So these are VIX jumps that are not explained by the model when taking into account the observed stock market return on that day. I've also color-coded these for values in excess of 3, plus or minus 3. So these red are indicating it was a negative stock market return. Green are indicating a positive stock market return. And so these are all periods when the stock market fell and the VIX jumped, but the VIX jumped by more than the model is capturing. So this is where I need to work further on the specification for the variance bias. Also, the bias terms, they're highly transient in the non-Gaussian specification. In the Gaussian specification, by contrast, they're highly persistent. But with the non-Gaussian specification, we have highly transient biases from observed VIX relative to what is predicted for the VIX based on the variance state variables changing given observed Y. So in this non-Gaussian specification, the bias shocks have a half-life of 2 days. So that's certainly consistent with Ciliano's observation that there's a whole lot of noise, bid-ask spreads or something, that enters into the observed VIX relative to the underlying variance state variables. And of course, the whole role of this B is to try to filter out that noise to identify the variance state variables. Here's the B estimates. So here's full sample. The yellow line is the squared VIX, and then the blue line is the bias. And you can see that the bias is at times a substantial portion of the VIX, especially during, for example, the financial crisis 2007 to 2009, or during the pandemic. And here's some graphs that break those down. So here's the financial crisis when the VIX shot up to exceeding 80%. And you can see that the bias rose substantially as well, except for this term on October 20th. But yeah, so the bias is definitely a major component of the errors the VIX was making in terms of predicting future realized variance during this period. Pandemic wasn't quite so pronounced. So here's March of 2020, VIX again shoots up above 80%. Bias also shoots up, but it's, well, there's a fair amount of bias, just not as much as during the financial crisis. In terms of option implications, here's this graph that I gave previously about the tilt of the volatility smirk at various horizons. So that's what I'm trying to fit. Here's how it fits based on time series analysis. So using the estimated variance state variable evolution with leverage at both slower moving and faster moving components. This is, I've got a major gap, so I was hoping to fit better, but I fit worse. So and the problem is, of course, V2 is faster mean reverting. If it's faster mean reverting, it's not capturing the longer term phenomena as well as a model that says it's slower mean reverting. And by the way, in terms of these fits, I'm just doing a transformation of measure using a risk aversion of 2.5 and no volatility risk premium for when it comes to the option pricing for what is predicted for these various slope of the volatility smirk at various horizons. So it's not doing well, basically. By contrast, the Anderson-Fusari-Todorov model fits option prices at all maturities pretty well. But I also note that their U factor that they use to match the longer maturity, the smirk at all maturities, has a half-life of 8 years. So according to the option prices that they fit, and their model is, of course, fitting state variables to match the cross-section of all option prices, or all strike prices, all maturities, they require a very slow-moving variable with a half-life of 8 years to capture this stuff out at the longer maturities. From this model, we're not observing such slower-moving state variable evolution. So just to conclude, I would say the first model, which uses just stock market data, and I've done some subsample estimates, which I won't present. The model one is heavily affected by volatility evolution during the Great Depression, when volatility got to very high levels and was at very high levels for years. Whereas model three, which adds this VIX data, is more focused on modern data, including how the VIX evolves and correspondingly creates faster volatility mean reversion. But a consequence of that, in terms of time series analysis, is that these models actually fit options worse than models with slower moving dynamics. Okay, so, and that's my conclusion.
All right, thanks very much, David. Now it's time for me to invite anyone to unmute him or herself and ask a question or questions using the microphone. So for audience, it's your chance.
David, Steve Figluski here. I really like this line of research, and I really like your paper, even though it hasn't been written yet, if I've understood correctly. But I'm looking forward to liking it tremendously when you do write it, and please send me a copy. I just wanted to check on one thing. Am I correct in thinking that that your bias captures a variance risk premium, but it's the reason it varies is essentially statistical properties of the stock return series. In other words, my question is there variance in the utility functions of the investors? In other words, do they become more scared about a given level of a jump risk over time? Is that varying? And does your model capture that, or is it all different evaluations of statistical probabilities of future returns?
I would say the latter. So I am not explicitly modeling what this bias should be. I could do that. I mean, in a sense, I sort of did that with the those option results at the very end, where I did an explicit change of measure to go from the actual to the risk neutral. But the bias is really just a statistical property. I observe the VIX. I have my forecast of what the VIX should be based on these V1s and V2s. And then that error is used to update my estimates of V1 and V2. But while recognizing that there is this bias component, so how much weight should we give to the latest Z, as opposed to the fact that anyways, it's purely statistical, I would say. So it's a decomposition. The VIX and VIX changes are being decomposed into the VIX changes either because of these V's or because there's noise here. The overall filtration structure is estimating how relatively frequently, how much we can rely on changes in Z to attribute them to changes in V1 and V2, as opposed to just changes in bias. And Stylianos's points about the VIX is a lousy series with a lot of noise, I fully embrace, actually. Frankly, my preference in terms of this sort of estimation would just be go back to the old VIX of using an at the money implied volatility, which is much more actively traded and is not worrying about this entire portfolio. And then furthermore, the VIX as a variance measure, as opposed to a volatility measure, also becomes very sensitive. So I think there are a lot of measurement error issues, but in no sense am I doing a pricing exercise and making any conclusions as to what is the appropriate compensation for risk.
If somebody wanted to add an entire different dimension to this model, they could do so perhaps by making modeling investor risk variations in investors' risk attitudes. In other words, that's as you. My question was: is that included in what you've got here? And your answer, it seemed to me, was that not really. So, if one wanted to go add something really different to this model, you might do things like looking at sentiment or that kind of thing, variations in that. I'm not suggesting that you should do that in this model. I'm thinking that if one is looking to push beyond what you can get from statistical analysis of returns, that's a direction maybe to go.
Well, certainly we could, I'll cite the Anderson et al. Paper again, in which they found that their EU factor was very heavily correlated with the noise factor that Jun Pan came up with. So now whether you take the noise factor as mispricing in the options markets because of failure of financial intermediation, or alternatively possibly compensation for risk during especially turbulent periods. In any case, what we do observe is the bias is especially pronounced during these turbulent periods like 2008. Stylianos?
Oh, just a suggestion, as you know, you may know, I've been peddling, if you like, a model of stochastic volatility mixed with jumps, and which, to a point of information, we've applied actually to various, and, we do find a very big disconnect between priced volatility and observed, if you like, volatility in the option market, which, in other words, the stochastic dominance bounds we provide are lower overall, and sometimes much lower than the extracted, the midpoint of the bid-ask spread, which is why you have also all these problems, why they don't follow in it, and particularly in the middle, in the ATM region. That's where we observed. Now, I don't know the information. We've been looking now at the option market, like Professor Figlewski noted. You know, they may be the investor, but you see, they are not homogeneous. And for your information, there is the liquidity provider is a monopolist, meaning that there is only one liquidity provider, at least for the SPX and SPXW options. And of course, he has information advantages. So it's not a competitive market. So we don't know how to handle it. Maybe for the moment, we are working on it. That's all the information I have but I would, if I were you, I would separate and put the leverage of those who entered the shocks that are that got into the leverage, that get into the index, into the utility from the others. In our approach, these shocks that get into the utility are priced, the others are not. Okay, that's a suggestion if you want.
Again, I said I'm avoiding pricing issues, so I do have leverage in both components of V, but I'm not attempting to price them in any sense. This is a statistical exercise.
I know, but this is interesting though economically. You know, there are some.
Well, in terms of a monopolist, I guess there's some argument for that. There are relatively few option market making firms, Citadel and the others, that seem to be heavily on the other side. But that just says that the pricing kernel that we ought to use is that of the monopolists rather than of the. So the Citadel is selling them and everybody else is buying them, and that's the pricing kernel we have. I talk a bit about those issues in my survey as well, if you see my opinions on that topic. Okay, other questions?
So David, so you have a theoretically motivated model for the VIX, right? You solve for the VIX given your model, as I understand it. But then you also have an ad hoc model for the bias. So your model for the observed VIX is actually, as I understand it, is the sum of what I'll call a theoretically well-motivated model plus an ad hoc model for the bias. Now, maybe you'll disagree with that, but let me go on. So actually you have an ad hoc model for the VIX. So is there a better ad hoc model for the VIX?
Well, this first component, sorry, that's not quite the slide I want. Okay, so the VIX, we're taking the expected quadratic variation under the objective measure. So that's a purely time series exercise. So in an affine model, we have these weights, W0, these weights, W0, W1, W2, but that's from the S model. Yep. So there's no compensation for risk there. It's the objective, not the risk neutral. And then there's the bias. And you're absolutely right that it's an ad hoc model for the bias. So as a maximum likelihood exercise, I'm just trying to get as good a model as I can to match how the Z, what is the Z distribution in order to use the Z for filtering V1 and V2. And certainly I've noted in these QQ plots here that there are definitely problems with this. So yes, what I think would be a better model would be a co-jump model. So there's more so at the moment, I'm just using information from returns when updating. I'm only using, sorry, let me go back. I'm only using this information. The bias is a function of returns relative to what's expected. So that's somewhat linear. And then there's also this jump component. But there's more information we can get from jumps. And so I'm thinking about a co-jump model where we have these jumps. We have these jumps that affect stock market returns, also affect the VIX via this term. they also could affect the bias. So there's all sorts of things you can filter using this filtration methodology. You can filter the probability that a jump occurred. You can filter the size of the jump. You can filter the size of V jumps versus the size of Y jumps. So there's all sorts of information that can be extracted from using Z and Y as information variables regarding these latent variables. And that information could be incorporated into this model of the bias. So that would be a more explicit co-jump model of, basically, for example, the bias is a function of how many jumps occurred in a given day minus how many jumps are expected to occur. That would be adding an additional variable that we could filter from the Y and Z variables. I haven't done that, however, yet. That's something I'm exploring, but I haven't implemented that yet.
If I may jump in, so that would give you a better fit to the VIX, but what's your feeling about how you would close the gap with the correlation picture? The skew.
I think that would just, what that would do would take care of some of these outliers. And I don't think it would resolve the skew problem at longer maturity. So in terms of that, I can think of two approaches I could take. One is to go to a three-factor model. So if I went to a three-factor model instead of a two-factor model, then I would have faster, medium, and slower moving. So basically, you have to filter out the fast-moving stuff before you can identify the slow-moving stuff. That would be one approach, but of course, that's getting messier. Another approach would be to go directly to the Anderson-Fazore-Todorov specification, which has more aggressive leverage effects. They have a different structure of the co-jumps. And basically, they go from the Y jumps to the V jumps. They take the Y jumps and they square them on the downside, which creates a very aggressive V jump response. That would probably magnify all these jump numbers. And so that would be an approach that probably would push these lines closer to the average value. Trouble
But
is
then
that,
that would,
sorry, go
but
ahead.
then that would be at the expense of the fit under P, right?
I don't know how well it would fit under P.
Yeah.
One thing about the Anderson et al. Paper is they explicitly model at the very short end by requiring the diffusive component to be identical under the objective and risk neutral. How it would match under the P measure, I'm not sure, because I haven't done the exercise. It's a messier program.
Thanks.
David, one thing that as we were talking might be interesting to look at, maybe you have looked at a little bit. If you're thinking about things, mechanical things in the market that are not part of the model, margin calls could be one. And if you get a couple of jumps coming close together in the same direction, there could be people who are forced into taking positions that are not optimal, optimal choices. They're just stuck having to liquidate positions that they've been in. And so two jumps in a row could be a whole lot different from one big jump, or I'm not sure what, but you perhaps have looked at this already.
Well, just in terms of the fact that we do have these self-exciting structures. So intradaily, the jumps are small, but when you get these big 10% movements in the market, it's definitely a run of jumps. So that's what my 2019 Journal of Finance paper showed.
Mm-hmm.
The intradaily movements are quite small, but you get a run of them. So that certainly could be a relevant phenomenon. Yeah. So I'm at this point, I'll just make a personal statement of my own opinion on this, which is I'm skeptical of compensation for risk models, or perhaps saying that it's just these are rents to the financial intermediaries who are prepared to be on the other side selling these things. So my personal response is I no longer try to explain rationally why they're priced the way they are. I just sell them. They sell out of the money puts.
Well, that's sure one way to see the world.